Great, you've got the heading, so we can start with theory. Obviously, we're focusing still on partnerships. So remember, a partnership is going to have more than one sole proprietor. A sole proprietor combining forces with another sole proprietor will create a partnership. So we know 2 or more partners will create a partnership. In chapter 24, the heading here is obviously structural changes. So they've said here, changes in partnerships. So what changes do you think can occur in a partnership?
Maybe other partners retire.
Yes, good. So the first one, the partnership could end. Okay, so people retiring perhaps.
So I just list these.
Yeah, number 1, or you can just say changes that can occur. Number 1. Termination of the partnership, so the partnership basically ends. Termination, that's the first one. In brackets, you can say something like a partner retires, or a partner leaves, or okay, it could be the partnership could end for a whole host of different reasons, such as retirement. Okay. The second one, new partners are added. So admission of new partners. Adding new partners. And the last one that's mentioned here in the textbook is changing the profit sharing ratio. Right, so we can either end the partnership, maybe partners retire, they leave, whatever happens. We can add more partners. So let's say we start a partnership with 2 individuals, then we bring in individual 3, 4, 5, and we have a bigger partnership. Another option is, well, let's change the profit sharing ratio. So before it was 50-50, maybe we're changing it because maybe one partner is doing a bit more than the other. Okay. Right, so then they give you just a bit of examples in terms of dates. Okay, so when the partnership actually changes. We need to identify that date as being very, very, very important. So separate considerations, say the date of change is important. So if the partnership changes today, then from this point forward, we need to account for everything based on the new partners that are applicable in the actual partnership. Right, so we know new partners can join, okay, or partners can leave, either or. It makes no difference. The same thing will apply. Right, the date of change is very important. Okay, so the first topic that they've covered in this textbook is the admission of a new partner. So this should be a separate heading. How many do you have here? Let's see. Admission. Okay, goodwill is part of the admission. Valuation of goodwill. Still goodwill. Still goodwill. Wow, lots of goodwill, hey? And that's it. They didn't mention anything. Okay, the retirement of the partner, that's much later. Okay, so the big one is adding new partners. Admission of a new partner. And then later on, we've got the retirement and the leaving. Dissolution, yeah. Okay, so looks like they've focused their attention on the admission of a new partner. That's the key. So that's a big heading. Everything underneath this will relate to that topic. Okay, so I'm just going to give you general rules and then we can look at an example. Okay, we'll take this example and we'll work through the numbers. You'll see it's actually quite straightforward. I'm going to start off just by giving you the general steps. So what must you do when you admit a new partner? Okay, so step number 1. Identify the date of change in the partnership. Okay, so depending on what date you're going to admit the new partner. So if I'm going to admit a new partner at the end of the year, then the end of the year is the key date. Okay, and everything needs to revolve around that one date. Right, so identify date of change. Okay, so if I just read this example, we'll do the example later, but I just want you to identify the date of change. Okay, so Adele and Gaynor are in a partnership. They share profits and losses equally. Their financial year end is 31st December. Okay, financial year end is always important. They admit Chin as a partner on 1st July 2014. Is that important?
Yeah.
Yes, there's the date of change. Okay, and everything now is going to focus on that one particular date.
Mm-hmm.
Right, but remember the date of change is halfway during the financial year. Okay, because their financial year is 31st December.
Yeah.
And when are they admitted to the new partner? 1st of July. So half the year it's the old partnership, the rest of the year it's the new partnership.
Yeah.
Okay, step number 2.
Okay.
Determine what the existing partners are entitled to. Determine what the existing partners are entitled to. Okay, what do I mean by that? We'll put a note just now. Determine what the existing partners are entitled to. Okay, so I'm going to use these people just in the example just to describe it. Right, so do you agree they've chosen to change the partnership? A and G want to admit C to the partnership. Okay, so before we had 2, now we're going to have 3. Right, if I'm looking at what do the existing partners have, what accounts represent A and G?
Appropriation.
No, appropriation represents the partnership as a whole.
Oh.
What account represents A and G? The capital.
Oh.
Okay, so underneath that, put a note.
Mm-hmm.
Still the same point.
On the same point.
Yeah, same point.
What am I saying?
Determine the separate capital account balances. Okay, so you're trying to find the capital account balances for each partner at the date of change. Why is that important? Well, let's think about it. Okay, you are operating a partnership with partner A.
So determine separate capital.
Capital account balances. Yeah, that's what you're going to have to do. Right, so if I'm looking at A and G, do you agree A and G would have been operating for probably a few years? We don't know how long they've been operating. Right, but according to the example, they want to admit a new partner on the 1st of July. So is A and G going to want to know how much equity they have in the business on the 1st of July?
Mm-hmm.
Of course they do. Why? They need to know how much to charge C for entering the business. Okay, so is C going to join the business without having to pay anything? Probably not. Okay, if C wants to be part of the partnership, C needs to contribute something.
Yeah.
All right, they need to contribute their own capital to start the business. So if I read the rest of the example, they say, they agree that A, G, and C will share profits 3-1 respectively. The profit for the year ended was 40,000. The profit will accrue evenly throughout the year. Okay, then they want you to prepare some accounts. Right, we know that C is being admitted to the partnership. So if C is being admitted to the partnership, C needs to pay a certain amount towards the partnership. So bullet number 3 would be determine the value of the partnership at date of change. Okay, so now we're looking at how much is the business worth at that point in time.
Determine value.
Determine value of the business or partnership, if you want to use that, because it is a partnership. Determine value of the partnership at date of change.
So like what is the business worth?
Exactly. Okay, then a sub point underneath that job. You need to put a note there. Revaluation accounts. You will have to do a revaluation account when admitting a new partner. The reason being is that those assets that you had owned could have changed in terms of value. Okay, so revaluation accounts. Revaluation accounts. Okay, what does the revaluation account do? It values the business at the date of change.
Yeah.
Okay, so A and B, they've been operating for, I don't know, 5 years. Right, they bought a building 5 years ago. The building is probably going to increase in value. So the building they have today is going to be worth more than the building they bought 5 years ago. Right, so are they going to enjoy the benefit of an increase in the value of the building?
Yeah.
Of course. Why? They were the ones that owned it.
Yeah.
Okay, so that's what you're doing. Right, the next bullet, next step.
Okay.
Add the new partner. Okay, so the new partner is added. Right, so how are we going to add a new partner? We're going to process their transactions. Right, so the new partner contributes capital to be admitted to the partnership.
So a new partner?
New partner is added, process transactions.
New partner added.
Brackets.
After?
Well, the new partner is added. So
Yeah.
how do you add the partner? You need to process their transactions. So if they contribute anything, they need to record it. And then the last step is the goodwill calculation. Next step, goodwill calculation.
Is that the last one?
Yeah, goodwill is what the...
Is this part of the steps?
Yes, part of the steps, goodwill calculation.
I'm going to start this on a new page because it's like say.
No, goodwill calculation is the last step, and then goodwill will have its own notes. Okay, so goodwill is its own topic. No, but it's still, you still need to put it there because there's one step, and then goodwill you'll put as a new heading as well. Okay, so just to finish off the step part, because this was admission of a new partner, the last step is just to, you can just say calculate goodwill. We don't know what goodwill is yet. Okay, we're going to explain it, and that can be your new heading on the new page. Okay, so there are 5 steps in total. You can break these steps up further if you want to. There are more things to consider, but what you've got there is what you would have to do when changing the partnership. Okay, goodwill. Alright, so now you can put a heading. Yes, okay, so page 207 starts by describing what goodwill is. Goodwill is something that we need to look at when dealing with partners in a partnership because there's value that's being created, and that's what we need to look at. Okay, so now we need to cover this concept. Goodwill. It's probably the first time you've heard of it, so we'll write a definition for it. Okay, so goodwill definition, I'll read it here from the textbook. Goodwill is the cost of acquiring a business less than the total value of the assets and liabilities that have been purchased. Okay, so in other words, goodwill is the additional benefit that the existing partners have created that is measured when the partnership changes, basically.
Okay, so let me write that.
Goodwill, additional benefits generated over the life of the business.
Small benefit generated
over the life of the business. Comma, which is measured at date of change. Got that? Okay, which is measured at date of change. Okay, next bullet for goodwill. If that's benefit, what type of account do you think goodwill is?
Liability? No, asset.
Yes, assets. Okay, because it is created over the life of the business. Okay, we'll use an example just not to explain it, but let's just get the theory down.
So it's an asset, eh?
Yeah, be more specific. Write down intangible assets. Intangible means you can't see it, you can't touch it. Okay, again, we'll discuss it with an example just now. Okay, intangible assets. That's what it is. Assets have balances on the debit side that you should know. So we treat goodwill as an asset. Okay. Here they explain what intangible is. It cannot be seen. It has no physical presence. It's not like other assets like premises, machine, or vehicles. Okay, that's obviously self-explanatory. Right, so in this example, right, you've got equipment, you've got fittings and furniture. That makes up 42,400. Then you've got inventory, bank, and cash. And that makes up another 3,640. In terms of total value, this company is worth 46,040. Okay, so that's the value. The company could have been worth anything, it doesn't matter. So, second bullet, you can just say, or not second bullet, just underneath this, just say example, e.g. Okay, so let's explain what goodwill is. Okay, e.g.
Okay.
Right, so if I'm going to be selling a business at more than the worth of the assets, have I created additional value? Yes. Okay, when would a business be worth more than what it's actually worth?
When gains clients.
When it has reputation, exactly. So think about a business that has started and has been running for 10 years. Does that business have any equity?
Yeah.
Yes. Does the business have assets? Yes. Does the business have something else? Yes, goodwill. Okay, so the goodwill is the stuff that you can't measure, but you can only measure it when someone is willing to buy your business. Okay, because the business is the business. Right, so let's just say like this room. Okay, this property has value. Okay, the furniture, the fittings, all of the stuff in here has value. Okay, but now because you're running a business, okay, the longer that business has been running for, the more valuable that business becomes in terms of, inverted commas, goodwill. Okay, it's something that you can't measure, but you can only measure it when someone's willing to buy the business. Okay, so if someone's wanting to buy your business now, there won't be much goodwill to measure because the business is very new. Okay, but maybe after 4, 5, 6, 7, 8, 9, 10 years, the business is worth more. So someone would be willing to pay more than what the assets are worth in the business because it's that other stuff that you can't see, that you can't touch, that they value as being valuable. Okay, so it's kind of like goodwill. Another word for goodwill would be like reputation. Okay, brand. Right, so you're building a brand, you're building reputation, and the longer the business operates, the more goodwill, the more brand, the more reputation you create. Okay, so the example, you can say assets equal, we'll keep it simple, okay, just say assets equal 100, liabilities equal 40.
Yeah, just wait.
Okay, I'm just keeping the numbers small so it's easy to calculate. Okay, we could have used this example, but these numbers are quite big, but the same thing is communicated.
Liabilities?
Liabilities equals 60, no, 40, I think I said 40, yeah, 40. Okay, so if the assets are 100 and the liabilities are 40, can I find the missing one?
Yeah.
What is the missing one?
The good one.
No, the owner's equity. Okay, owner's equity is equal to what? Do you still remember the formula? OE equals A minus L. Okay, so what is the assets? 100. What are the liabilities? 40. 100 minus 40 is 60. Right, so the owners of this business, there could be one owner, there could be multiple. If we're looking at partnerships, there's going to be, let's say, 2 or 3. Okay, so the 2 partners that own this business have how much equity in the business? 60. Right, they want to admit a new partner. and that partner is willing to pay to join the business. Right, so when looking at goodwill, you're looking at how much are you going to be selling the business for, and how much is that person willing to pay for a share of the business. Okay, right, so to keep the example simple, we'll say this is a sole proprietor. Okay, we can bring the partnership stuff later on. Here they've only looked at one person, Terry. Terry owning her business, Terry selling her business. Okay, so if Terry's business is worth 60 on paper, okay, and someone, let's say...
Is this what the business is worth?
Yes, because the assets minus the liabilities is the net worth, right? Owner's equity. Owner's equity we know is the net worth. Right, so if you sell all the assets and you pay off all the liabilities, the business is worth 60. Who gets that? The owner. Okay, so now you can just say an investor wants to buy the business. The offer price is 80. Okay, so someone, doesn't matter who, anyone. I'm just using...
buy the business.
Yeah, investor wants to buy the business. Or you can say Terry wants to sell her business. Either or, it makes the same.
So an investor wants to buy the business?
The offer price is 80. Is there goodwill? What do you think?
Yeah.
Yes, there would be. Okay, why? Is the investor paying more than what the business is worth? Yes, they are. Okay, so the only way we can measure goodwill is by determining what the business is worth today and looking at what people are willing to pay for it.
So there is goodwill of 20.
Exactly. Okay, show the working, 80 minus 60.
It's okay.
You know that, okay. Alright, so goodwill is just that. Goodwill is the additional benefit that isn't measurable, it isn't tangible. Like, there's no asset sitting in the company that's goodwill. Okay, goodwill is something totally abstract. Okay, it's someone's willingness to pay you more for something.
It's like reputation.
It's like reputation, track record, brand. Okay, right, so that's what goodwill is. Now we know what it is. Do you agree? Okay, next bullet. This is separate, so a pink bullet separate to what we just spoke about. Okay, now we need to look at this, the valuation of goodwill. Right, so now we know what it is. Now we need to know how to value it. Okay, so they say we cannot give a definitive method that can be used in every type of business when goodwill has to be valued. So the first point. Goodwill is difficult to measure reliably. That's the first bullet. Right, so even the textbook says we cannot give a definitive method that can be used in every type of business because all businesses are different. Right, if you had to value a sole proprietor, you would value that business different to a partnership or a company.
So I'm going to say, yeah, the
goodwill is difficult to measure reliably. Okay, but they do give you methods that you can apply. Okay, so now we've got method number one. Well, let's put another heading. Methods to use to value goodwill. Okay, so these are ways that we are going to be, different ways that we're going to be using for valuing goodwill. Right, so yeah, goodwill is difficult to measure reliably, and these are some of the methods that we can use. Okay, so method number one, here's it. Okay, methods to value goodwill. Number one.
Just give me a second. Number one.
A multiple of average profits. A multiple of average profits. Ooh, careful. A multiple of average profits over the past few years. Okay, we do need to show examples for this because that doesn't make much sense, so we need to look at an example. Okay. Right, but it's just a multiple. A multiple meaning it's a measure of the average profit over the last few years. Okay, so let's say the business is 5 years old. Okay, is the business going to have profit over 5 years? Probably. Okay, hopefully. Alright, so that's what we're looking at here. Okay, so just to read this example, it's short, so it's not long. It has been agreed that goodwill to be valued at 2 years purchase of the average profits taken over the past 5 years. Right, so have a look. They've decided to value the business based on what? Its average profits. Right, so if you know that the business is creating a certain amount of profit every year, and let's say the business has been operating for 5 years, you could say, well, the business is worth an average of 5 years worth of its profits. Does that kind of make sense? Yeah. All right, but remember, that's not a definitive method. It's just one method to determine what the business is worth. Okay, it's just one of a few. Okay, so number one is what you just wrote down. Okay, so just say e.g. example. Yeah, you'll need a bit more room to do that because we need to write a few things down. Okay, so you can just say example, e.g. Okay, just say business A has profit for 5 years as follows. Business A has profit over 5 years as follows. Okay, we're just going to write down 5 numbers. I'm going to keep the numbers short and simple so it's easy to calculate. Okay, we can do the working on the calculator. Oh, did you bring the calculator? Okay, it's fine, we'll use the phone.
I do have it.
Oh, you do have it? Oh, yeah, there you go. You've got it, great. Alright, 5 years. So you can just say number 1, year 1, or number 1, either or, 100. Year 2, 70. Year 3, 80. Year 4, 110. Year 5, 120. Okay, so step number 1, calculate the average. Right, so how do we calculate the average? We add up all the amounts and we divide it by the number of years. Okay, so how many years do we have here? 5 years. Okay, 100 plus, that's 330.
The average is 96.
Is it 96? Okay, great. Are you happy with the calculation for the average? Okay, good.
I just add them all together and divide them by 5.
By 5, correct. That's right. Okay, so that's the first step, get the average. Okay, then the second bullet is the question mark, alright? Because we won't know how to value this business if we're not told. Okay, so people can place value on this business based on the average. Okay, so you could say the business is worth 5 years worth of its average profit, or you can say the business is worth 2 years worth of its average profit. So you can just make a note here as this. You see, this is that whole word. It's not definitive. Okay, you can just say the business's value is based on a certain number of years multiplied by its average.
The business's value is
based on a certain number of years. Okay, so if I'm basing my valuation on 2 years, I'm going to take 2 years, I'm going to multiply it by 96. Okay, if I want to value the business over 5 years, I'll take 5 and I'll multiply it by 96. Okay, so depending on how many years you have as an expectation, you would say that business is worth a multiple of its average profits. Okay, so last bullet, you can just say a multiple of its average profit is the value. So, or you can say value equals multiple times average profits. Okay, multiple is like 1, 2, 3. Okay, so I could have a multiple of 2. 2 times the average profit. I could have 3 times the average profit, 4 times the average profit.
So that the multiple word, what will the multiple word?
A number. So 2 years.
So it's 2 years. Okay.
It could be 2 years. It could be 5 years. Yeah. Okay. So the example said it has been agreed that GoodWILL be valued at 2 years of the average profit. So that's just what they're referring to. That they have to tell you, that you can't decide for yourself. Okay, the question will have to say what the number of years is.
Yeah.
Okay, so if you want to put in an EG, you can just say EG 2 years times 96 equals 192, I think. 2 years times 96. See, 96 is the average, equals
192.
Yes. Okay, so you would believe that this business is worth how much? $192. Okay. Right, that's method number 1. Method number 2. A multiple of average weekly sales. Right, so the first method was using the average profit. Now we're looking at the average sales, but the weekly sales. A multiple of average weekly sales over past years. It's always over past years because you're evaluating the business based on what it has done. Okay.
Okay.
Alright, so here, just read this example. It has been agreed that GoodWILL be valued at 4 weeks purchase of average weekly sales over the past financial year. Okay, so you can say, as an example, e.g., if annual sales are, let's just use 1,000, just to keep it simple. Annual sales is 1,000. Okay, how many weeks in a year?
How many weeks in a year? I don't know.
52.
Okay.
Okay, so if annual sales is 100, what is weekly sales?
1,000.
Divided by?
Yeah.
52. Okay, so that's the next step. Calculate weekly sales. Okay, because the question...
Annual, okay, so annual is yearly.
Yeah.
If annual sales is 1,000,
calculate weekly sales. Okay, so there are 52 weeks in a year. You'd have to divide by 52 and then times by the number of weeks. The multiple.
So 52.
Yeah, 52
Okay,
weeks.
so we say 1,000.
1,000 divided by 52 equals a number. What is it equal to? Equals, answer, that you'll have to work out on the calculator. Okay, 19.23. Right, so what is that representing? The weekly sales. Right, remember, it's a multiple of the weekly sales. And again, the multiple will be given. So very similar to what you had here earlier. You could say value equals. Value equals.
Yeah.
Multiple times average weekly sales. Right, so the question has to tell you how many weeks you're going to be using to value the business. Right, that must be given. Like you said, the number of years, that'll be multiple, will be number of weeks in this example.
Yeah.
Okay, so if I use this example in the textbook, they say that we must use 4 weeks of the average weekly sales. Right, so it would be, the multiple is 4 times the average weekly sales. Right, so if I use the same thing here, it will be e.g. 4 times 19.23 equals a value.
So this would be 4 weeks, eh?
4 weeks, yeah. Because the multiple here is look at the number of weeks times the average weekly sales. Okay, so how much is that?
76.92.
Okay, so that's the value that we would place on the business based on that number. Okay. Alright, there are two more methods. There's still method 3 and 4, and then that covers the valuation of goodwill. Okay, method 3. Method 3 is multiple of an average of the gross fees earned. As you're looking at income. Multiple of the average gross fees earned. What type of business would this relate to? Which businesses? Average gross fees earned. Right, so what type of business would have fees? Trading or service? Yeah, service. Okay, trading entities will have revenue. So a trading entity would use profit or weekly sales. That's what they could use. Okay, here we're looking at fees specifically, so this would be best suited for service entity. Okay, right, it's very similar. You can just say value equals multiple times average gross fees earned.
Average
gross fees earned.
Okay.
Right, so in the textbook they gave you 4 years. Right, we'll use 4 years as well. Okay, so you can say e.g. gross fees for year 1, or gross fees equals, and then you can put 4 years.
That's fine.
Okay, so year 1, 50, year 2, 60, year 3, 70, year 4, 80. Let's keep the numbers simple. Okay, so what am I going to do with this? Add them up, divided by 4, okay, for gross fees.
Average is 65.
Okay, and then again, they must tell you what the multiple is. Okay, so in the textbook they said 2 years. So we're going to use 2 years of the average gross fees over the last 4 years. Right, so it would literally just be 2 times 65 then equals an answer. And the last method, number 4, multiple of super profits.
Okay, then the last one.
Number 4, multiple of super profits. Okay, super profits, you can highlight that. We need to explain what that means.
Yeah.
Okay, so underneath the word super profits are calculated using the principle of opportunity costs. Okay, opportunity costs we've covered in business and economics. Okay, opportunity costs are those costs that you forego, okay, the things that you give up. Right, so the bullet there, super profits are calculated using the principle of opportunity cost. Do you still remember what an opportunity cost is?
Calculated using?
Using the principle of opportunity cost. Do you still remember what opportunity costs are? Okay.
It's what you give up.
Exactly. So just asterisk that. The cost or the benefit foregone. Okay, or foregone. Right, it's what you give up, exactly what you said. Okay. Right, even the textbook here gives a definition for opportunity cost. See, I'll read it. Opportunity cost is the cost of making a decision in terms of the benefit lost by not using a resource in the next best alternative. Okay, so it's what you give up when you decide to do something else. Okay, so if you do A, you give up B. Okay, so what you give up is the opportunity cost of that decision. Does that make sense? Okay, right, so this example, they talk about a property developer. Okay, Durgan. Okay, so let's just write down the key points. You can just say example, e.g. Okay, the first point that we need to note is his capital. 50,000 capital. That's the first point. Okay, second point, business generating profit of 38,000. Business generating profit of 38,000. Okay, then the information in the question needs to talk about opportunity costs. Right, so do you agree this guy is a property developer? Okay, he invested 50,000 in his business, and this business is generating a profit of 38,000. Okay, if he wasn't running a business, he would be working as an employee. Okay, so they have to tell you about opportunity costs. Right, so he's either going to own the business and run the business, or he's going to work for someone else as an employee. Okay, so that's the second part. This is what they talk about in terms of opportunity costs. Right, so this you can asterisk as the opportunity cost. If he worked for an employer, he could earn 23,000 a year. 23,000 per annum. Right, so that's the opportunity cost. Right, so we need to look at what the business is actually worth.
So he would have earned?
He would have earned 23,000 per annum, PA, per annum. Okay, so now what are we trying to do? We're trying to work out the value of his business based on what? The opportunity cost of giving up the salary. Does that make sense? Okay, that's kind of what you're doing here when you look at this concept of super profits. Right, so we've got all the values. Now we just need to calculate it. Right, so the first step is to work out the super profit. So super profit is what we give up. Right, so what does he give up?
24.
Good. And what is he earning currently?
38.
38. So which is better? Is it better to own the property company, or is it better to work for an employer?
Better to earn.
It's better to earn as the business owner. Right, so does he make a super profit?
Yeah.
Yes, he makes more running the property business than if he did working for someone else. Okay, so that's the first step. Step number one, super profit equals 38,000 minus 23,000. You wrote 23,000. It was 20. Yeah, it was 23,000. Sorry, it was right. Okay, minus 23,000. Okay, what does that give you? I think it's 17. 27. Ooh, show my fans. 27,000. Okay. Right, so 27,000 representing what?
Super profit.
His super profit. Okay, what he actually generates on top of what he would have lost if he worked for a separate business. Okay, so are we going to use this as a multiple? Yes. So now we could value the business and we could say, well, this business is a multiple of his super profits. Okay, so we're saying the business is worth in excess, okay, of what he would be earning if he was employed elsewhere. Okay, it's quite an abstract way of measuring a business. This is quite a different way of measuring a business.
2 years times 27.
Times 27, yeah, or 3 years, or 4 years, or 5 years. Again, it would depend on your expectation, your estimate. Okay, that's 54. Right, happy. Okay, so now there's all the methods. Those are the 4 methods. There's quite a bit of theory here at the end of the textbook. They talk about factors that contribute to the establishment of goodwill. Okay, we know that goodwill relates to reputation. So I'm just going to read these points out. I don't think they're that important because as long as you understand what the concept is, you could probably come up with these points.
Yeah.
Okay, so point number 1, good reputation because the quality of the products are very high. Okay, does that create goodwill?
Yeah.
Of course it does. Good reputation because of good service.
Yeah.
Good reputation for the helpfulness of staff. Good after-sales service, prominent physical location, popularity amongst customers. Those are some of the bullets they've mentioned that would help contribute to establishing or creating goodwill. Okay, as long as you know what goodwill is, you could probably come up with some of those reasons, right?
Yeah.
Okay, perfect. Right, now we've got some accounting coming up. You can start this. This is a totally separate heading. Okay, so we had 2 headings so far. One heading was what is goodwill. Second heading was how to measure it. Now we've got a different concept, adjusting the capital for goodwill. Okay, because who is entitled to the goodwill? The existing owners, the people that created it. Okay, that's the next heading. Separate heading, separate bullets. The point is adjustments to capital to record goodwill. It doesn't have to be partners, it could be anybody. Here they're just focusing on partners. Adjusting capital accounts for goodwill. You can just keep it simple. Adjusting capital accounts for goodwill. Okay, bullet number 1. Bullet number 1, calculate goodwill. Bullet number 2, allocate goodwill. Okay, so step number 1 is always to either work it out. So we've got 4 different methods to calculate it. Okay, here they've given it to you because they've calculated previously using one of those methods.
So calculate goodwill, this one?
Yeah, calculate goodwill. Number 2 is the allocation. See, now we're going to be allocating it. This is what we're looking at now. Right, so calculating goodwill would have been one of those 4 methods. Number 2, allocate goodwill to the owners. And if the owners are partners, you'll allocate it to the partners. If the owners are shareholders, you'll allocate it to shareholders. It doesn't really matter what type of business you've got. Okay, it could be a private business that has equity in the business. Okay, allocate goodwill to owners. Right, so what are we going to do with goodwill? Debit or credit?
Increase.
Yes, how? Debit or credit? Good. Okay, so there's the accounting. Alright, so goodwill is an asset, so you debit the asset. So debit goodwill bracket asset increase. Debit goodwill bracket asset increase. That's the understanding, that's the basics. That's like the stuff we covered right at the beginning. Okay. What are we going to credit? There's no cash here. Who gets the goodwill? Yes, capital. Credit capital, bracket. You can say owner's equity increases if you want to, that's fine. Okay, we know capital is capital. Capital is always a credit. Okay, perfect. Alright, so obviously they've given you like a big example there. Have a look. all these T accounts, and all they've done here is they've shown the addition to their capital accounts for the goodwill. So in this example, goodwill was valued at 8,000, and then they allocated goodwill to each of the partners. Okay, it doesn't matter how many partners I have, I'm going to do that for all of them. I'm going to debit goodwill, credit capital, debit goodwill, credit capital. Okay, so if I've got 3 partners, I'm going to divide the goodwill by 3 and give them each a third. Okay, makes sense. All right, that's quite logical. Okay, next one. Next bullet. No, not next heading. It's still part of this whole adjustment. It's just a separate consideration. Okay, what happens if no goodwill account is introduced? Adjustments made when no goodwill account is introduced. What does that mean? We don't have any goodwill. Okay, so is it possible to adjust the business? Yes. Okay, when would you adjust the business? When new partners come into the business. Okay, so A and B working together. Now we want C to come in. Okay, if C is going to come in, what must we do? Value the business. Okay, assuming there's no goodwill, that's what they said here. Assuming no goodwill, can you still adjust? Yes, you can. Okay, and you'd have to adjust based on that revaluation. Okay, where's the revaluation? There's the revaluation. Okay, so still part of the main heading, adjusting capital accounts for goodwill, but you're talking about revaluation of assets and liabilities. So you can maybe use that.
So must I say revaluation?
Yeah, revaluation of assets and liabilities. Okay, I don't know why they said when no goodwill account is introduced. Even if there was goodwill, you could still revalue your assets. The revaluation can be done whether there is goodwill or whether there isn't goodwill. It wouldn't make a difference. Okay.
Revaluation of assets
and liabilities.
It's like a subheading.
Yes, like a subheading. Okay, here you're going to have to draw a T account for the revaluation. Okay, so the revaluation is done in a T account. So draw up a big T account. You'll need about, let's see, 1, 2, 3, 4, 5, 6 lines. That will be enough. Okay, so the revaluation account is like your appropriation account. A revaluation account doesn't have a balance. A revaluation account is purely used as a working account in order to calculate what the owners are going to get. Does that make sense? Okay, so let's make a note about that. You can label this revaluation account. Next to it, just write down working account. It doesn't have a balance. You close it off. Okay, so I'm going to use smaller numbers. I'm not going to use such big numbers, but we'll cover the same thing. Okay, right. So let's assume that A and B are running a business. Okay, A and B bought land and buildings 5 years ago, and those land and buildings were worth 100. Okay, today they want to admit C to the business. Okay, the same land and buildings is worth 150. What do you think you're going to do with the 50? You're going to increase the land and buildings. No, it's not goodwill. Okay, goodwill.
Oh, yeah. Okay.
Goodwill is related to when someone wants to buy the business. Okay, no one bought the business here. It's just the assets have gone up in value. That's all. Does that make sense?
Yeah.
Okay, so underneath this T account, write some points down because then we can show it in the actual T account. So bullet number 1. Land and buildings year 1 equals 100. Okay, next line, land and buildings today, brackets, 5 years later equals 150. Okay, so just put that element of time. Okay, so when you first buy the land and building, that's 5 years ago, that's year 1. Okay, the buildings are worth more 5 years later. Okay, so land and buildings today, bracket year 5 equals 150. Okay, so looking at that, what happened?
Land and buildings increased.
Good. So how do you increase land and buildings? Well, we'll use the revaluation, but debit or credits?
Debit.
Good. So underneath this, put a working. Debit land and buildings, credit revaluation. There's the working. That's how you get the credits and the debits.
So debit land and buildings.
Debit land and buildings, asset increase, basics again. See, the better you know the basics, the easier this is. Asset increase. Okay. Credit what? Revaluation. Revaluation account. It's a T account. Okay, revaluation doesn't have an element. Alright, so in the revaluation account, what are you going to show?
Land and buildings.
Land and buildings, good, 50. There you go. Okay, let's do another example. They only looked at non-current assets here. They just revalued non-current assets. I'm going to add the liabilities as well here to cover both. Maybe there's an example later that talks about the liabilities. Let's see. Oh yeah, there is. Revaluation. Okay, so we're actually covering a later example. That's fine. Okay, I'm looking at page 217.
Okay.
Alright, so that's the first example. Second example, you can say, bullet number 1. Let's do 2 examples. I'm going to do 2 more examples. So in the second example, you can say trade receivables. Trade receivables must be increased by 20. Okay, this is part of the revaluation. Okay, so you believe that your trade receivables need to be increased by an additional 20. Okay, for whatever reason. There could be different reasons why you would want to increase that. Okay, if you're going to be increasing your trade receivables, what are you going to do to trade receivables?
Gonna trade receivables is the assets and debits.
Exactly. So there, debits, trade receivables, credit, revaluation. And then one more example, let's talk about liabilities. Okay, so trade payables. Trade payables must be increased by, let's use 30. Increased by 30. Okay, so how do you increase trade payables? Trade payables. What is trade payables? Yeah, trade payables is a liability. Liabilities increase on the credit side, so you would have to credit it if you're going to increase it. Okay, so credit trade payables, debit revaluation. Right, so those last 2 that we spoke about, let's put them in the T accounts. Good, with?
No.
Yeah, you're right. Credit revaluation with trade receivables. Okay, we need to record those 2 valuations. I think I said 20, hey? Okay. And then debit the revaluation with the trade payables. That was 30. Right, and then this is the separate bit that we need to discuss, which is the balancing, which is the allocation of the valuation to who? The owners, exactly. So looking at the valuation account, okay, skip a few lines, skip maybe 2 lines or 3 lines, just put the total like at the bottom. Okay, put 2 total lines at the bottom. Okay, which side is bigger here?
Side.
Good. Okay, so what total do we write there? We write the bigger amount. So 50 plus 20 is 70. So write 70 on both sides. Okay, so am I missing something on the Debit side?
Yeah.
Yes. So what are you going to do? You're going to balance this account off. The balancing of the account is going to be for whose account? The owner. Okay, so you're going to write there capital, asterisk it, write down capital. Maybe underneath in a different color in pencil, just write balancing figure. That's the balancing figure.
Yeah, I will color capital and then
the difference, 40, exactly. Okay, so if you are debiting revaluation, okay, so write that down over here. Debit revaluation. Yeah, it's a balancing figure. Okay, so if I'm debiting revaluation, what account am I crediting?
Capital.
Exactly. So what's happening to capital?
Increasing.
It's increasing. Why did it increase? Because your land and buildings and your trade receivables was worth more than what it was. Okay, the net effect, even though your liabilities went up, the benefit outweighed the decrease. Does that make sense?
Yeah.
Okay, so who gets the benefits?
The owner.
The owner. Okay, so just in maybe a different color, just write down that capital consideration. Okay, so you're debiting revaluation, like we did here with the other three. Okay, so debit revaluation, credit capital. That's the working that you would need to process the revaluation to the owner's accounts. Okay, that's just something additional, something standalone, something separate to consider. Debit revaluation, credit capital, and that's that yellow highlighting that you did earlier. Okay. Right, so that covers that example as well. We've got two more things to do, and then we're done. Retirement of a partner, that's 2 pages, and a partner leaving. Okay, we're almost there. And then we've covered the theory. We'll start with the assignment next week. Let's just write down all the theory.
Okay.
Wow, there's still companies as well here. Okay, it's quite long. Okay, we won't finish all the theory today. It's quite a bit. Okay, but let's finish the partner stuff first, and then the company stuff we'll leave for later. Okay, new heading, new topic. Retirement of a partner. Okay, so retirement means the partner wants to leave. Stop working. Okay, if the partner's going to leave, what do you think we're going to do to his accounts?
Decrease it.
Decrease it, exactly. Good. Okay, so we need steps here. Okay, step number 1. Determine the total capital at date of retirement. Okay, so if you're wanting to leave your partnership, you need to know, well, how much equity do you have in the business the day that you leave the business? Does that make sense? It's pretty logical, actually. Okay, so if you're wanting to leave the partnership, determine total capital at date of retirement. Okay, what account represents the total capital? The capital. Right, so the partner's capital. Okay, number 2. Revalue assets and adjust the capital. Okay, so at the date of retirement, you'd have to check, are all the assets still worth what they're worth?
So revalue assets
revalue assets and liabilities and adjust the capital account, or adjust the capital account. And then the last step is to close or remove or retire the partner's account. Okay, so in other words, we're removing it, we're taking it away.
So revalue assets and liabilities and adjust capital.
Correct,
okay.
Yeah. Okay, and the last step is to obviously remove the retiring partner. Okay, so number 3, remove the retired partner's accounts. Okay, so you remove his capital. You basically pay him out. Okay, so how do we pay out a partner? We debit the capital, we credit the bank if we're paying them out. So that would be a separate payout. Okay. Yeah. So paying out the partner, you can say debit capital. See, this is the first time you've ever debited capital. Why? Because it's a retiring of the partner. The partner's leaving. Okay, debit capital. Debit capital, credit bank. You're paying them out. Makes sense?
Yeah.
Perfect. Okay. Methods of paying out the partner when they leave. Okay, this is just theory. You don't have to write anything here. Okay, so they've just given you theory. How can I pay the partner when they choose to leave? Well, I can pay them cash. I can. What else do they say? Retiring a partner's capital account balance could be transferred to a loan account. See, you could give the account a loan account, meaning you owe them. Okay, you owe them for their capital. What else do they say? Pay off the old partner, borrow from the bank. Okay, that's that. Okay, that was the one. And then the second thing is change to the partner to the profit sharing ratio. Separate. Okay, retirement is done.
This is the next one.
Yeah, that's done. Retirement is done. The last bit of the partnership stuff was the change in the profit sharing ratio. New heading. Change to profit sharing ratio. Okay, so what is the profit sharing ratio? What is the profit sharing ratio? The split.
Yeah.
Do you agree? Okay, so the best way I can show you how to change the ratio is by doing an example. But let's just highlight what this is. Okay, so bullet number 1. A fraction or percentage allocated to each partner. That's what it is. A fraction or percentage allocated to each partner. Okay, e.g. example. Let's show the change.
Okay.
Right, so example, e.g. A and B share things equally.
Okay.
C enters the business and will get 1/4 of the business, a quarter. We'll say 25%. Let's use percentage so we can use both. I can show you how to do the percentage as well. And we'll get 25% of the business. Relinquished by A and B equally. Okay, relinquished just means given up.
So C enters business and gets 25% of the business.
Say given up by A and B.
What is it given up by?
Given up by A and B equally. Okay, so now let's show the calculation.
Okay.
Okay, so you're going to have to write down, let me use a pencil here. Okay, A equals 50%, B equals 50%, two different lines. Okay, 50% is what fraction? 1/2. So equals 1/2 equals 1/2. Okay, fractions are better here. So rather use fractions than percentages, because percentages are a bit more tricky because you can't really convert them back, right? Especially if you're looking at giving up a share of a share. Okay, so how much does C get?
25%.
Good. What is 25% as a fraction?
I think it's 1 over 4.
Yes, it's a quarter, correct. Okay, so on the next line, write down C equals 25% equals 1 over 4. Okay, so now we know how much C is going to get, but C is going to get this 1/4 from where? From A and B. C, so circle that, because that's where the quarter is going to come from. Does that make sense?
Yeah.
Okay, because the business is only worth 100%. 100% is 100%, that's everything, right?
Yeah.
How much is C going to get of the business? 25%. Where is it coming from? It's coming from A, and it's coming from B. Does that make sense?
Mm-hmm.
Perfect. Okay. Right, so if I've got a quarter, this quarter is going to be given up by who? A and B. Do A and B relinquish the quarter in the same ratio?
Yeah.
Yes, equally. Right, so now this quarter, we're going to split like this. Okay, draw like an arrow like that. Okay, so this 1/4, split it into 2 lines like that to show the splits. Splits and splits. Perfect. Okay, so, and you can write 50%, 50%. So each of the partners give up 50-50. Does that make sense? Okay, so what is 50%? What is a half of a quarter? A half times a quarter is 1 over 2 times 1 over 4 equals 1 over 8. Okay.
So what did you say?
A half of a quarter. Yeah, so there's the quarter, and you're looking at a half of a quarter. 1 over 2 times 1 over 4 is equal to 1 over 8. Okay, so put 1 over 8 there and 1 over 8 at the bottom. Right, so who gives up the 1 over 8?
Each one.
Exactly. Okay, so come back to this. You're going to have to squeeze it in.
Yeah.
All right, a half and a half minus 1 over 8 minus 1 over 8. Okay, so now we need to do some maths. What is a half minus 1 over 8? Well, a half is 4 over 8. So 4 over 8 minus 1 over 8 is 3 over 8. Okay, so 3 over 8. 3 over 8. Right, so how much does each partner have?
3 over 8.
Yes, so A has 3 over 8. How much does B have?
3 over 8.
3 over 8. How much does C have?
1 over 8.
Oh no, 1 over 4. 1 over 4 is a quarter. How much is a quarter in eighths?
Sorry, 1 over 8.
Yeah, how much is a quarter in eighths?
1/2.
2 over 8.
2.
Yeah, so 2 over 8. See, because 1 over 8 plus 1 over 8 is 2 over 8. Okay, so just highlight the 1 over 4 and just write 2 over 8. Or just do that, that's even better. Okay, last bit, just highlight the 3, highlight the 3, highlight the 2. Correct. Okay, and that's how you change the ratio. Okay, so A and B can give up a share of the business and they can give it to C. If they do it, they're going to have to give up some of their business to give it to someone else. Okay, if that person had to pay something for the business, then you'd have to calculate goodwill. That's separate. Okay.
Cool.
Alright, I don't want to start with this because this is quite long. You can see.
Yeah.
Have a look. It's like 3, 4, 5, 6 pages, and then there's a little bit of companies.